Hello and welcome back. I'm Ben. I'm a finance professor, and today we're talking about Q1 2022 earnings from S&P 500 firms. As of this date, 99% of firms have reported their Q1 earnings. Also, as of this date, the S&P 500 is down 18% since January 1st, so it's not a great year. I made a video 2 weeks before this. In that video, the PE ratio of the S&P 500 was 16.6. As of May 26th, the PE ratio is up to 17.1, but the 10-year average PE ratio of the S&P is 16.9. So at 17.1, we can't really say the market's expensive or cheap if we're using the PE ratio to make that determination. Something interesting, 56% of firms mentioned Ukraine in their Q1 earnings call. So Ukraine is having an impact on US firms. As far as industries go, the industries with the highest percentage of firms mentioning Ukraine are industrials and information technology firms. We're going to spend most of the video talking about earnings. The percentage of firms beating Wall Street estimates in Q1 was 77%. This is exactly the percent of firms over the last 5 years that have beat Wall Street earnings estimates. So the same percent of firms that usually beat Wall Street estimates are beating Wall Street estimates in Q1. However, the average earnings surprise over the last 5 years is 8.9%, and in Q1 2022, the average earnings surprise is 4.7%. So while the same number of firms are beating Wall Street estimates, the amount that they beat the estimates by is about half what it normally is. So if we look at the stock price change around the earnings announcement date, from 2 days before they announce earnings until 2 days after they announce earnings, firms are not seeing good share price reactions. The average firm that beats Wall Street estimates sees a minus 0.3% decrease in its share price around its earnings date, and the average firm that has earnings lower than Wall Street estimates sees a minus 5.1% change in share price. To see an increase in share price in Q1 2022, you need to beat Wall Street estimates by, on average, 20%. So you need to have huge earnings surprises to see your share price go up. Otherwise, it's going to be flat or drop. As far as earnings surprises go, the consumer discretionary industry has the worst performance. This is driven by both Amazon and Under Armour, which both were expected to see profits and saw large losses. The S&P 500 firm with the largest earnings surprise was Twitter, which has been all over the news since Elon Musk said he was taking over the company. As far as profit growth, now this is different than earnings surprise. Earnings surprise is what the firm reported relative to what Wall Street expected. Earnings growth is the change in earnings from Q1 2022 relative to Q1 2021. So the industry with the largest earnings growth is, not surprisingly, energy. Energy firms have made a huge comeback in recent months. The earnings growth of the energy industry is 268% relative to Q1 2021. So 268% earnings growth by energy firms over the last year. Next, we talk for a second about revenues. 73% of the S&P 500 firms reported revenues higher than Wall Street expected. On average, only 69% of firms report a revenue beat, so this is higher than average. Further, the average revenue surprise in Q1 2022 is 2.9%, while the average revenue surprise in the long run is 1.7%. So the earnings surprise is smaller than average, but the revenue surprise is bigger than average. Next, we talk for a second about profit margin. So the average net profit margin of S&P 500 firms in Q1 2022 was 12.3%. This is higher than the long run average of 11.2%. But net profit margin has fallen for 4 quarters in a row, so it's coming down. Next, we talk about the future of prices. If we add up the price targets from Wall Street estimates of all the firms in the S&P 500 for 1 year from now, what are the price targets of all 500 firms? We add it up, we get a projected level of the S&P 500 1 year from now. That number is 25% larger than the S&P was on May 26th. So Wall Street expects the S&P to be 25% higher May 26th, 2023, relative to May 26, 2022. Over that same time, Wall Street expects profits to grow by only 9%. This implies Wall Street expects the PE ratio to go up over the next 12 months. Take that for what you will. Finally, we talk about what industries Wall Street is the most bullish about. We're going to do this in 2 ways. First, we're going to look at the industries with the highest percentage of buy ratings by Wall Street analysts. There are 4 industries where 60% of the firms in the industries are a buy rating, which is the highest rating an analyst can give. Those 4 industries are energy, information technologies, communications, and the lagging consumer discretionary. So those 4 industries have the highest percentage of buy ratings by Wall Street analysts. The second metric we're going to look at to see which industries Wall Street is the most bullish about is the target price divided by the current price. So if the target price is significantly higher than the current price, Wall Street would be more bullish on that. So there are two industries where the target price is 40% above the current price. Those industries are communications and consumer discretionary. So the two industries that appear on both lists are communications and consumer discretionary. Those are the industries that Wall Street is the most bullish about. They see a 40% increase in prices 12 months from now relative to today for those two industries. All right, this has been a very quick market update. I'll try to do this every 2 weeks. Hopefully this was better than the last video I gave. Thanks for watching. Hopefully it's been helpful, and I'll do this again in a couple weeks.